Inflation's cooling. The market's bouncing back. Everybody's talking about how 2026 is going to be the year of easy money again. But Warren Buffett, the guy who's beaten the market for 6 straight decades, says this calm is fake. Because what's coming next isn't a crash or a boom, it's a reset. And if you don't know how to play this new game, you're about to get cleaned out by the same forces that made Buffett rich. Let's rewind. After 3 years of chaos, pandemic stimulus, crypto collapses, and AI mania, the U.S. economy looks stable on paper. GDP's positive, inflation's dropped from 9% to under 3%, and the S&P 500's back near record highs. But here's the part. Mainstream news won't tell you. The cost of money has never been higher in modern history. The Fed funds rate is holding near 6%. Mortgage rates are sitting around 7.2%. And corporate borrowing costs have tripled since 2020. Meaning, that easy credit era that built everything from Tesla to meme stocks? Gone. And as Buffett said back in 2008, only when the tide goes out do you discover who's been swimming naked. That's where we are again. The tide's pulling out, and a lot of investors, even billion-dollar ones, are about to get exposed. Now, let's break down Buffett's 4 timeless financial rules, and how each one lines up perfectly with the 2026 investing climate. Rule number 1. Cash flow over hype. For over a decade, Wall Street's been addicted to growth. Investors didn't care if a company made money, only that it could grow fast. They'd say, "Profit doesn't matter. We're building for the future." Sound familiar? That's how we got the AI bubble of 2025. Companies valued in the trillions with barely any earnings. But Buffett doesn't chase stories. He chases numbers. Buy businesses that earn cash, not ones that burn it. That's his entire model. Berkshire Hathaway owns companies that print money in any season. Geico, BNSF Railway, Coca-Cola. Products and services people keep paying for even when markets tank. Because in a high-interest rate world, cash is king again. If a company can't survive without borrowing, it's not a business. It's a liability waiting to pop. And that's why Buffett's been cutting tech exposure and doubling down on boring businesses. He's not being cautious, he's being patient. In 2026, boring is the new smart. Rule number 2. Stay in your circle of competence. Here's Buffett's second rule, and it's brutal in its simplicity. You don't have to be an expert on everything. Just stay inside your circle of competence. Translation? Don't invest in something you don't truly understand. That's exactly what he's warning investors about with AI right now. Everyone's talking about how AI will change everything. Maybe it will, but that doesn't mean every AI stock will win. Buffett's seen this movie before. He lived through the dot-com bubble, where thousands of internet companies popped up, and almost all of them died. He once carried around a list of 2,000 auto companies that existed in the early 1900s. Only 3 survived. So yeah, new tech might change the world, but it doesn't mean you can pick the winners. That's why Buffett's advice hits hard in 2026. If you don't understand it, don't touch it, because confusion disguised as confidence is how retail investors get smoked. Rule number 3. Be patient. When everyone's panicking. Right now, social media has turned investing into a game show. People are live streaming trades, showing off AI trading bots, and gambling on 24-hour options like it's a casino. Buffett's take? You don't have to swing at every pitch. Wait for your pitch. It's one of his oldest and most powerful rules. Patience beats prediction. Studies show that over 90% of day traders lose money within 12 months. Not because they're dumb, but because they can't sit still. Buffett's empire wasn't built on perfect timing, it was built on consistency. He buys when there's blood in the streets, holds when everyone else panics, and waits years, sometimes decades, for results. And here's the twist most people miss. Time in the market always beats timing the market. Even if you bought the S&P 500 at the worst possible time before every crash since 1970 and held, you'd still be up over 10x. That's Buffett's secret: endurance. Patience is a weapon in a world addicted to speed. Rule number 4. Own what the world can't live without. The fourth rule might be the most underrated. Buy the backbone, not the buzz. While everyone's piling into tech, Buffett's been quietly investing overseas, especially in Japan's big trading companies like Itochu and Mitsubishi. He's also loading up on energy, railroads, and utilities, companies that keep the world running no matter what happens. Why? Because these are the last things to go broke in a global downturn. You don't find out who's solid until the world gets shaken. And the world's shaking again. Geopolitics, debt, de-dollarization, inflation, and layoffs. Buffett's not scared of that. He's building for it. Here's what the mainstream isn't saying. Buffett's quietly preparing for a post-dollar economy. BRICS nations, Brazil, Russia, India, China, South Africa, are building alternatives to U.S. trade systems. Central banks are stacking gold at record levels. Buffett knows global trust in the dollar is fading, so he's positioning Berkshire in non-U.S. assets that still have pricing power. Energy, insurance, infrastructure. It's not paranoia, it's preparation. He's not betting against America. He's hedging against change. So what does this mean for 2026 investors like us? It means the next decade won't reward gamblers. It'll reward grinders. Buffett's 4 rules are basically survival tactics for the new market reality. 2026 problem. Buffett's solution: overvalued AI and hype buy cash flow businesses. Too many complex trends. Stay inside your circle of competence. Emotional, fast trading. Be patient. Wait for your pitch. Global instability. Own what the world can't live without. He's not chasing the next bubble. He's outlasting it. Buffett's wealth isn't built on risk. It's built on rationality. He's shown that in a world chasing quick wins, the slow, steady hand still wins the race. Because the market rewards consistency, not emotion. So what do you think? Is Buffett still right? Or is the game changing too fast even for him? Drop your thoughts below, because if even half of what's being whispered is true, then 50's whole anti-DL, call out the industry persona has been built on a front. And that would flip the whole script, especially for the folks who've been watching him play morality police for the last 2 decades.